Hello, my friends. Brett Pattison with IGGA Global Advisors coming at you from the financial capital of the West, which is Salt Lake City, Utah. Thank you for taking a few minutes of your time today on one of the most important weeks of the year for the market, where we are going to address, is the market going to be naughty or is it going to be nice heading into Christmas and the new year? And we'll address why this week is so important, as I just mentioned. First off, I've got to cover a few different things up front and just want to say thank you to those of you that are listening, that are clients of IGGA Global Advisors. We've doubled in the last year. As a result, people are starting to take notice as to what we're doing for folks, as our focus is building wealth and preserving wealth, including Utah Business Magazine, who has currently ranked us as a top 25 Utah firm. We're very proud of that. And we thank all of you clients that are listening for being great clients and for allowing us to serve you. We're starting to get recognized and we'll continue, I believe, as we do the right thing for you, continue to be recognized for. So thank you very much. Also, just a reminder for everyone out there that IGGA's process for investing is not a process, especially if you're new to IGGA Global, or if you're hearing from us for the first time. This is very important. Our process for investing is not results driven. And let me explain what I mean by that. Anytime you focus on I've got to have 4%, or I've got to have 10% returns, or I've got to have 20% return, whatever it is, you're in danger of taking too much risk. And I'm going to point out a specific detail as to how that's happened that's causing a lot of fear in the market right now. We are, as a firm, focused on probabilities. What are the probabilities of making money? We have a process, we follow it. It's much like a distribution curve, right? Where we look at the highest probabilities of making money for our clients, and we invest with that process and those probabilities in mind. That doesn't mean it's a guarantee. There's no guarantees, and you've got to manage the risk that you can see in the tails of that distribution curve, but the process is one of value. It's one of understanding our investments. It's one of not putting you at too much risk. That's very important for especially the conversation that we'll have in just a second. But let's focus on the global market returns year to date. Last week was a very, very bearish week in the market. We were down 4%. That caused a lot of fear to come into the markets. But let's take a longer view, not a real long view, but just year to date review of 2015, and you'll see that we've got the global tickers there, and I'll point out, and you can take a snapshot if you want of this chart, but the U.S. in red is leading the global markets, and it's down 1.78%. These are the prices as of Friday. The IFA, which is the developed non-U.S., think Europe, Asia, developed countries, down 4.39. The ACWI, which is a benchmark that we use quite heavily with our clients, is down 5.26%. And the emerging markets, China, India, those types of countries, down 19.7%. So it hasn't been a great year for equity returns. It's been, frankly, a crappy year for equity returns, right? And the one thing that we're seeing now is we're seeing that fear is back in the market. And I took this snapshot on Friday of the CNN Money Fear and Greed Index. And you can see that right now the reading is extreme fear. There's a lot of fear for what's happening in the bond market, which I will talk to you about. There's a lot of fear for interest rates rising potentially this week, which I will talk to you about. But the important thing to know right now is that most people are fearful. And the last thing that I want you to do is base all your decisions on how you're feeling now. You've got, most of you, 5, 10, 15, 20-year plans. 1 month of the year should not derail a decade-long investment plan, right? retirement plan, college savings plan, whatever that plan is. Yeah, there's a lot of fear right now, and let's address it, all right? And we can even look, for those that are familiar with the VIX, the volatility index, those of you that trade options, you can see it spiking to levels that we saw back in the, when we had the nice correction in August, September. And typically when it crosses that big dark line you can see there, right around 20, it's typically a decent time to buy equities, right? So it's that contrarian mindset. It's being greedy when others are fearful, and fearful when others are greedy, as Warren Buffett said. But that fear is back. And let's talk about why the fear is back. And a lot of it has to do with this yield trap. And let me explain to you what this yield trap is. Interest rates have been very, very low, and potentially will be on Wednesday when the Fed ends their meeting, potentially will go higher. But the point is that interest rates have been very low, and so people somehow get in their mind that they have to find yield to make return, right? They have to find yield, which is income, essentially, or they won't make money. And it gets in this yield trap because people start just searching for yield anywhere they can find it. And they buy absolute crap at insane prices because that particular investment may offer a yield. And it gets people in a lot of trouble. And it could be dividend-paying stocks that are just overvalued, ETFs that are overvalued that people think are great investments. Or it could be this particular ETF we have on your screen, which is HYG. It's a high-yield bond index. And for the last year, we've been warning people. Our clients, it's been on our website. We've talked a lot about it. Be careful for this area of the market. And on Friday, it just got hammered, and it was in the news, and a lot of funds now, not, mutual funds, hedge funds, not being able to redeem their clients' assets because there's no liquidity. It's turning into a mess. And here's the thing I want those of you that are not clients of Iron Gate to realize: if your advisor, or if you have been told to buy any of these products over the last year, I want you to seriously reconsider where you're getting that information. If your advisor has you in these crap products, I want you to seriously reconsider what you're doing, right? Because these are, it's down 11% year to date. They're overvalued, and the cracks in the high yield market are just beginning. And so be very careful where you find yield. And a couple alternatives that we have for clients are our options, are good, safe, dividend-paying stocks at a value, and potentially soon to be some good bonds that are, and we'll talk about that a little bit more, that maybe are completely undervalued and being thrown under the bus along with all the crap that's in this market. So review your portfolios. Caution if you have any of these investments. For those clients that are a little bit more or a little bit more aggressive that have money with us, you'll know that we've been short this particular area of the market for some time. And so and that's not a recommendation, by the way, but you've got to realize what you own in your portfolios. All right? So with that, let's talk about a very important thing that we will be addressing this week, or that the Fed will be addressing, and that's interest rates. And I bring this up because people are scared to death of interest rates. They've been so low, and the Fed's talking about raising them 0.25%, and this is going to happen on the 16th, right? That's when the Fed has their meeting, or the meeting ends with their decision. And so what does this really mean? Well, in the short term, when that decision comes out, you may see a very significant rally, depending upon the language that the Fed uses. If they don't raise interest rates, you may see a very, bearish move to the downside, very quick. You may see that regardless. You may see one or the other regardless of their decision. And the key here is, hopefully you've removed risk as far as options in December already, like you should have. But when that decision comes out, just know that a 10-minute or a 1-day or even a 1-week move does not derail, again, a long-term plan. And speaking of long-term, I want to focus on interest rates. Interest rates rising are not bad for stocks. You've got to realize that. And I'm going to point out a couple things here. On the far left-hand side, you'll see the different dates as to when interest rates were very, very low and they started rising, right? That's the far left, 70s through the 2004, okay? The columns on the far right are the next 12 months return and the next 24-month percent returns. And you can see that the average return for the next 12 months, 7%. The average return for the next 24 months is 19%. Because when the Fed raises rates, it's not a bad thing. It's actually a healthy, that means our economy is healthy. And ignore all the bearish stuff you're hearing. And you've got to focus on the facts, and these are the facts. Again, it goes back to our process. Our process is focusing on the probabilities. Okay, well, if you're focusing on the probabilities, you've got to look at when was the last time that this occurred in the market, right? Where interest rates were low. And how did the market react? When X happened, when this event happened, how did Y react, right? And that's what these probabilities are saying. It's not a guarantee. There are a down year or two in there, but overall the averages look pretty darn good, and the economy looks pretty good, right? So the other thing to that, if interest rates are rising are not bad for stocks, what are they bad for? Well, they're bad for bonds, and I don't want to spend a ton of time because you've probably heard me preach this before, and we're already starting to see this, right? But a 1% increase, focus on the red. A 1% increase, which we're looking at a 0.25% this Wednesday, the 16th. But a 1% increase could mean a down 5% move in intermediate term bonds, 30-year treasuries, the long end of the curve, which is the most dangerous in this type of situation, down potentially 17%. So if you're just focused solely on yield, you may lose money. All right, you've got to know what's in your portfolio and what the risks are. A 1% increase will not come overnight, and that's what's going to be interesting to hear what the Fed has to say. But a 1% increase typically is not good for the bond market, right? However, I will say this. I'm expecting bonds to continue to get hammered, especially high yield. But the one thing that you've got to realize is when things are most bearish, when people are the most fearful, when things are just ugly and being torn apart like the high yield market, that's when opportunities arise. And so currently I've got to tell you that we are looking for dislocations in the credit market, in that high yield market especially, and we're looking for great investments that are trading at a great value, not a high value, a low valuation, right? At a good value that we can buy that makes sense for our clients. And we could potentially see some great discounts on some good bonds that could be, or bond funds that could be great investments. But we will take it cautiously, right? Just like 2008 when we're looking at good stocks to buy. It's that same mentality. It can turn out to be a great investment over time. So that's one thing to be aware of as far as interest rates. Two things, actually. It's not bad for equities. It's good for equities, but it's bad for bonds, right? And we could potentially see some of that money flow going from bonds into the equity market. So the second thing I wanted to mention today is something, and here's also a reminder. We've been talking about this interest rate, concept. We've been telling you about interest rates for a very long time. We've got a web page just for you. You can see right there, write down that URL. It's it's important for you to understand the impact of interest rates on the equity and bond market. That web page has a ton of information for you to listen to read. Also, some videos for you to watch that'll give you more information if you're unclear as to what's going to happen. All right, there's interest rates. The next thing is the rest of the year, something known by people as the Santa Claus rally. And again, I'm going to go back to our process for investing. Our process is very simple. We look at the historical returns. We look at historical cycles. We wonder what happens when X occurs to Y, right? It's that whole variable in determining the probability of something happening. And I got to tell you, we look at the history of the stock market, and November through April, which we find ourselves in right now, typically averages about 7% return. May through October is that bleak period, 0.8%, 1%-ish. But the best months of the year are November, December, April. And And we haven't felt that yet, but I'll talk about why we still could. The worst months of the year, June, August, September. So let's focus on that December for a moment. We know just based on history that it's a very good month. And typically in December, 1.5% of that 1.7% happens only in a few days. And I'll address why. It's something called the Santa Claus rally, right? And some of you are maybe rolling your eyes when you hear this, but I'll tell you, if you study the history of the stock market, this stuff happens, right? It happens. And so don't be so scared of the market right now, because we could approach this. So what is it? What is the Santa Claus rally? What am I talking about? Well, it's simple. It is the 7 trading days after Christmas, so it includes some of the first of 2016. The average return is in those 7 days is 1.6%. So most of that 1.7% return, I think it was in December. Well, almost all that is in these 7 trading days, right? Or 5 trading days if you're just looking at the end of December. So why does this happen? And it, think about a couple things. Think of end of tax loss selling. So what does that mean? End of year, it's at the end of every year. What portfolio managers will do is they'll look at their clients' portfolios and they'll look at it and say, hey, is there any losses that we have on these underlyings that our clients can offset gains from? And so they'll sell something at a loss. Think of any energy stocks you have right now. We've seen energy just get hammered, and a lot of that is tax loss selling. They'll sell something, take advantage of the loss so that you can write off some of the gains you may have on your taxes. That usually occurs, November through the first part of December. We may be seeing some of that right now. I think some of that was last week. That usually ends, before Christmas. And so what happens is people start buying again. The end of tax loss selling is here. Let's start buying. A lot of that, you have to wait 30 days, right? So those people that sold in November could start buying again in December, and that ends, and so people start selling. Year-end bonuses also come in, and people invest those year-end bonuses. So that's bullish, and it's just a holiday spirit. And that sounds weird, but it actually exists. It's the holiday spirit. People have maybe received extra cash, maybe, those year-end bonuses, and so they buy stocks. And that Santa Claus rally, again, a 1.6% return, but you need to understand when it happens. The 7 trading days after Christmas is what that is. All right, so don't be so scared. Don't be so fearful. And there's not a 100% guarantee that this happens. There's about an 80% probability that it happens, which means a 20% probability it doesn't, right? So don't be so fearful right now in the markets. Look at that fear, that CNN Money Fear Index, as an opportunity, not something to sell all your stocks on. So one last reminder as we wrap up, if you haven't made contributions to your IRAs, to your 401ks, whatever it may be, there's your contribution limits. Just remember that going into the new year, and we'll continue to remind people of that. Please know that we have your best interests in mind. If you have any questions pertaining to any of this or any other questions you may have, feel free to email us, brian@igga.com. That's my partner. I am brett@igga.com. More than happy to assist you with anything you may need. If you want us to review your portfolios, you have it with somebody else, more than happy to do so as well. But don't let the fear ruin your Christmas that's in the market. I'm optimistic. I'm excited for the opportunities. Even if the market goes down, there's always going to be opportunities, right? To buy great things at great values. Got to look at it that way. All right, my friends. Thanks for joining us today. If you have any questions, let me know. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.